Welcome to the webinar, Opportunities in the Crypto Derivatives Market. We are the derivatives team of AMINA Bank, Andreja, Amrit, and Dennis. And in this 1 hour call, we're going to present to you the main kind of facts and dynamics of the crypto derivatives market and main opportunities for this market environment that we are in. There is going to be a 45-minute presentation followed by a 10 to 15-minute Q&A. For the Q&A, please use the on-screen chat, and because this is a chat that everyone who is attending is present in, please use it in a relevant and respectful manner. So there's going to be 3 parts to the webinar today. The first part will be presented by Dennis, and it will be the part about use cases, instruments, volumes, and the recent very strong growth that this market has experienced. Then the second part will be presented by me, and there we're going to look at some very interesting structures that are relevant for the bull market that we are in right now, and that can help you, balance your portfolios and take advantage of derivatives to improve your risk reward. And then to close the webinar, it's going to be Amrit with some very nice instruments that are exotics and that you can also find and use in the cryptos today. So I pass on to you, Dennis.
Thank you, Andreja. And as we navigate through this webinar here today, we're going to uncover the power of crypto derivatives through the lens of 3 key pillars that are important not only for the crypto derivatives market, but for the overall derivatives market, also in traditional assets. It's going to be about liquidity, mitigating risks, and portfolio diversification. So first, on liquidity. Crypto derivatives play a pivotal role in enhancing market liquidity, drawing a broader pool of investors and traders into the market. And this surge in liquidity not only fuels the market growth, but also fosters a more dynamic and accessible environment for all parties involved. Next, risk mitigation. Derivatives are also a powerful tool for protecting portfolios from unforeseen or unexpected twists and turns in the market. Whether it's hedging against price volatility or shielding against adverse market conditions, derivatives offer a shield of resilience for investors. And third, portfolio diversification. I mean, this is a cornerstone of modern investment strategies, and I'm sure you're well aware of that topic, but also for the crypto derivatives market, it plays a pivotal role. Investors are able to expand their investment universe and horizon across multiple cryptocurrencies and unlocking new avenues for growth and allowing them to master advanced trading strategies that Andreja is going to talk about later on in more detail. And now we are going to focus on the 3 key tools that are used within the crypto derivatives universe. It's going to be crypto futures, crypto perpetuals, and the crypto options. So let's start off with the futures and perpetual swaps. What you see here on the left side is a generic price chart, historical price chart. Since it's moving up, let's assume it's Bitcoin over time. And the blue dotted line above the historical price chart shows the futures price. There are 3 observations visibly immediately. First, the futures price is trading at a premium to the spot price most of the time, constantly. It's highly correlated to the spot price. And as you can see, also it is converging to the spot price at expiry date. Futures in general are regulated financial instruments that allow the market participants to speculate on the future price movements of the cryptocurrencies. In the futures universe, the cryptocurrency market is focused on Bitcoin and Ethereum for now. It's not only the speculation on future price movements, but also, of course, futures are used for hedging purposes against price volatility. An important point of futures is that they are settled in cash. And that means that actual cryptocurrencies are not exchanged upon the contract expiration. Instead, the difference between the market price and the settlement price determines the profit or loss, basically. And the settlement is happening on a daily basis. And this allows traders basically the use of these futures, cryptocurrency futures, allows traders to gain exposure to the cryptocurrency market without actually owning it. Of course, there is always a downside to it. They are very capital intensive trading futures, but they're also known for its safer investment vehicle compared to the perpetual swaps I'm talking about later, since, as I mentioned, they are regulated financial instruments. One of the most popular strategies that Andreja is going to talk about later as well is the basis trade, in which basically the difference between those two prices of the futures contract and the spot price is earned. Let's move on to the crypto perpetuals or crypto swaps. Perpetual swaps, also known as perps. As you can clearly see here, that the price of the perps are much more aligned with this underlying spot price as the futures price. So this is one of the key features of the perpetuals. Perpetuals also only exist in the cryptocurrency market. They were invented in 2016 by BitMEX. And a major difference between the perps and the futures is that the perpetual contract has no expiry date. So it's basically trading indefinitely. And as you can see, the price of the perpetual contract is aligned very closely to the spot price. And this is guaranteed by a so-called funding mechanism. And the perpetual contracts incorporate a funding mechanism to ensure the price aligns closely with the underlying asset spot price. And these funding rates are periodically exchanged between the long and the short positions to maintain this alignment. What are perpetuals used for? Who is using these perpetual swaps? Generally, there is a leverage component to it, obviously. It amplifies both the profit, but also the losses. The feature of the perpetuals also enables the traders to control larger positions with a smaller amount of capital, but at the same time, it also increases the risk, obviously. As we have seen in the last couple of weeks with the weak market performance, a lot of long positions in these perpetual swaps were liquidated because of the underlying risk here. And the trading flexibility is also an important part of it. Traders can enter and exit perpetual positions at any point in time, making them suitable for short-term strategies as well as longer-term speculative positions in many different underlying assets, and are also therefore used mainly by retail investors, whereas the futures market is mainly reserved for the institutional traders, as they are, as I mentioned before, more capital intensive as the perpetual swaps. All right, these are the basics. Let's have a look at the historical development of perpetuals and futures over time. As we can see here on the left chart, the open interest in both the futures and the swaps has increased significantly throughout the last years. But most interesting here on this chart is actually the black line, which I call the institutionals investors dominance. It's how much more open interest is in the futures that are here traded on CME versus the perpetual swaps and overall market size. And as we can see, there has been a clearly uptick in the investors trading investors dominance throughout the last years. One big move happened in November 2022. We all remember big exchanges collapsed, bankruptcy cases, and this was one point in time where investors fled into a safe haven onto CME. And then also this year, a sharp increase in the share of open interest of CME traded futures, supported by the launch of the Bitcoin ETF in January this year. Next topic are vanilla options. We've now covered the futures and the perpetuals. Vanilla options are a main and very important derivative tool for the cryptocurrency market. They are basically involving the buying and selling of calls and puts on underlying cryptocurrencies. The main traded options, or the most of the open interest, is traded in Bitcoin and Ethereum options. And the standard setting is also that they are settled in cash, same as the futures, or USDC, for example. How do I gain access to these options? Either via exchanges. We're going to later see who these exchanges are and where the volume is actually traded. You can also enter volumes. You can enter higher volumes and liquidity in options through the OTC market via bilateral agreements with market makers. And the third point is structured products, which is also a topic that has experienced massive demand throughout the last 2 years, where you basically are able to trade options or gain option exposure via a product that has an ISIN, for example. What strategies can we use with trading options? Andreja is going to highlight a few of those, but overall, it's all about hedging, it's about leveraging, it's about yield enhancement, covered call, overriding strategies, and of course, cryptocurrencies trade at an elevated volatility level, so it also attracts volatility traders into the market. A few important metrics to mention here is the spot price. The spot price is an important factor in the determination of the price of an option, call, or a put. The implied volatility, so the expected volatility or the expected risk, as you can also say, over time, and the skew of calls versus puts, for example. In the cryptocurrency market, there is a tendency for a call skew, meaning that calls generally trade at a higher implied volatility compared to the puts. And that's just because the sentiment and narrative in the cryptocurrency market is very bullish. So the expectancy or the optimism on future price increases on Bitcoin and Ethereum and so on is much stronger than in the traditional asset classes, for example. Let's have a look, as promised, on the market overview. And before I'm going to give you the current stand, let's take a look in the back mirror and see how much open interest and where the open interest in futures and options has been traded by around a year ago. So on the left side, we have the open interest distributed by various exchanges in futures and perpetuals. And on the right side, the same for options, vanilla options in Bitcoin and Ethereum. As we can see in March, end of March last year, Binance ranked first in open interest. So basically commitment of traders in trading perpetuals with around 6 billion in open interest. CME was yeah, almost second place. OKX was around just shy above 2 billion in open interest. But as we will see in a second, this has changed significantly this year. On the option side, there is basically a monopoly position here. Deribit is the clear leader. Around 90% of open interest have been traded on Deribit in vanilla options, Bitcoin and Ethereum. CME and the other exchanges play a rather benign role in the option play. This year, this has completely changed. So CME has now outranked the futures and perpetuals or futures open interest across all exchanges. You see a significant increase with around over 10 billion in open interest in Bitcoin and Ethereum futures, whereas Binance also, the market grew throughout the last 12, 13 months, but has not made it possible to keep his rank, his first rank. On the option side, still Deribit is in the first place, around 25 billion in options open interest are traded here, followed by OKX and CME. The daily traded volume is around 68 billion a day for the first quarter this year, and around 3 billion in options for this first quarter. There is also another way to trade options in the crypto derivatives market space, and that's in the DeFi market, which is more or less a retail play. So I'm just going to highlight the most important parts here. So-called option vaults, DeFi option vaults, allow investors to stake their coins into a protocol, which then deploys these assets into a variety of option strategies. The most important are covered calls, so short calls, and covered puts. The total value locked by April this year was around 30 million, much lower volumes than we've seen in April 2022, where these TVLs were around 500 million. So before I hand over the word to Andreja, I would like you to have a quick look here at the historical implied volatility charts of Bitcoin and Ethereum compared to the VIX index, so the implied volatility on the S&P 500 index. Just 3 takeaways from here before I hand over. First, what we can see is that the implied volatility decreased over time, and that is a clear attestation for a maturing asset class and institutional adoption. More liquidity in the market is usually bringing volatility down. Nevertheless, volatility is still elevated compared to other asset classes, which makes it an attractive play or environment for trading option strategies. And with that being said, I'm handing over to Andreja now, who is going to speak about option plays.
Thanks, Dennis. Thank you very much.
Hey, Andrea. Hello. Andrea, you're muted, if you can check.
Right. Apologies.
Yeah, perfect.
I muted myself. So thanks, Dennis. We stay on this slide just for a few seconds to note that the implied volatility on crypto is between 3x, 2x, 3x at the lows, and all the way to 4x or 5x, 6, even more versus the S&P. And so it's 2 interesting things, you know. How do you harness this volatility for yield, or how do you actually take leverage in this market? How do you take cheap leverage in this market when the vol is this high? And one more thing also, which Dennis mentioned, the call skew is higher than the put skew, which basically says also that the moves on the upside in Bitcoin have been pronounced. You know, it's expectation, but it's also the history on the side of these moves. So we dive into the first trade here, and that's the basis trade mentioned before. And this trade is interesting because it's a market neutral trade. And on the right side, we can look at the historical annualized yield. It's averaged over 1 month. We average it because if we looked at every day, it would be a little bit too many spikes on the graph. But you can see that it's possible to capture without directional risk annualized yields that are in double-digit percent and go all the way to 25-30% as an average possibility over a month. If you look on a daily level, then these numbers can even be 40 or 50% sometimes, right? So that's quite a nice yield that has no directional risk, market neutral. Now, so this is basically, this trade is interesting for anyone who has capital that is looking to make even single or double-digit percentage gains over a year. Usually, this trade is interesting when we have a bull market, and that's because at this time the demand for leverage on the long side is higher, and therefore people pay up to be long the future, and that's when you can basically sell the future and buy the spot. So it's a yield play, and what's important to note on this trade is that generally you have to execute it across 2 venues, which means it's a little bit capital intensive. Now, for the purposes of this webinar, I'm going to just focus on the most interesting parts of these trades. You're going to receive the slides of the webinar afterwards, and then you can look at also at all the other points that we're raising here on the slides. How are these trades financed? What are their greatest risks? And also a little bit more about the timing. So again, this trade is buy spot, sell the future. And the most important thing is the capital intensiveness of this trade. So how to efficiently use your capital to lock in these yields. Then the second interesting application of vanilla options in crypto are leveraged directional plays. And we looked at volatility that can be very high. So the question here is how to express directional views in a good risk reward with a very good risk reward. And we want to look today at a call spread on Bitcoin. So who is this trade for? What are the use cases? Well, if you're looking to join into the rally, for example, if you have cash on the sidelines and you want to join a rally in the crypto, but you feel that Bitcoin prices have run away already a lot, and there is also a chance of a larger pullback, 30%, 50%, then a call spread is a limited downside strategy that can give you upside exposure. And it consists of buying one option and selling another option, which basically neutralizes the high implied volatility levels that exist today. And in this example here, we're saying buy a 1 month 70,000 call and sell a 1 month 80,000 call. And this would cost $1,500. So effectively, it would give you something like a 6-to-1 risk-reward ratio. So think about that for a second. It's a 6-to-1 risk-reward for an event that we have seen materialize in the past 6 months, basically every month. That's quite nice, and that's actually what something that would be quite rare in the traditional markets. I think when you can usually find 3 or 4-to-1 risk-reward trades for bullish assets, it's considered very, very good. And here we have very often ability to put on 5x, 6x, or maybe 10x trades using call spreads. Again, there is a lot more information here on the slide about this trade, but I will leave that to you for after the presentation to look into. So next one, please. Then we have option yield plays, and these were also mentioned by Dennis before. So for a portfolio that is basically long coins, there are two situations here. Again, we're going to focus on a situation where someone is long Bitcoin and they want to harness some yield from the market. The way to do this is basically to sell calls and collect the premium of the call option. So at times when the market is going through a sideways consolidation, like it is at the moment, or during times of market weakness, market players who already own coins can basically sell upside and get that premium in their portfolio immediately. And again, due to high volatility levels, due to high prices of trade call options, these yields range from 10% annualized all the way we've seen in the past 60–70%. However, this trade is very popular, so the yields have been compressing over time, and lately they range between 10 to 30%. The nice thing about this trade is that if you're already long coins, and you can do this at the same place where you hold the coins, then it requires no extra capital. Something also that we have worked on here internally is that we see the best results when we apply this trade to shorter dated maturities ranging between 1 week and 3 weeks. Now you can do a similar trade if you are. So this trade is for someone who is already long and wants to basically raise yield on that portfolio. If you are in cash and you're looking to buy coins, but again, you think that maybe coins are a little bit too high, the prices are a little bit too high at the moment, then you can also apply a similar strategy by selling puts. This is also, we're not diving into more detail on that trade here, but it works in a very similar way. Another important thing about these yield plays is that they work best when they're applied systematically rather than as a one-off. So what's next? Thank you. Then we mentioned that derivatives can be used for hedging. So again, what kind of a situation would you like to deploy a hedging strategy in? Well, again, a portfolio that is long coins and has done very well, like in the past months, the investor might be looking to reduce their exposure. So you have several ways of doing this. You can just sell coins, but if you sell coins in a bull market, you're also giving up the upside. Now, in this case, very often with the vanilla options, you can lock in the gains on your position while still keeping considerable upside open. And in this case, we're showing you here basically spot market was at 62,000 when we put this trade together, and one would be able to lock in a selling price of at least 50,000 for the next 5 months. So basically, over the next 5 months, you're guaranteed to be able to sell your coins at $50,000 while still keeping the upside open all the way to 95,000. So rather than sell all your coins at 62,000, you can maybe sell a portion of them there and keep the rest and try to capture a lot more upside all the way to 95,000 while having a guaranteed exit at 50,000. This is a relatively simple trade. It requires a long put and a short call. It's also, again, if you're trading options with the same counterparty where you're holding the coins, then a trade like this will require no extra capital. You can do it 1-for-1 for each coin that you're long. Yeah, you can find also a little bit more details about this trade in the presentation later. Now, what are the other hedging strategies that we can deploy? Well, we can do a put spread, which is similar to a call spread that we talked about. It will require some additional capital, and but it will be basically you will not be giving up the upside on your position this way. Put spread collar, similar to the collar that we looked at. You can sell a future and enter a basis trade, and slightly less protected strategies is to sell a call and go into a call overriding position, or you can also use the call spread that we talked about by selling your spot and entering into a call spread. This way, having limited downside now, but still keeping some upside in your portfolio. And also, I invite you to look at the graph on the right for a moment. This is a graph of put and call of the difference in volatilities between a call and a put. And you can see that this is this graph oscillates, and the two red circles on the graph are two latest instances when the call volatilities reached a peak versus the put volatilities, and this aligned also with market stops. So again, following these dynamics in a volatility market can sometimes help you time your exits better. So with that, I pass on to Amrit and the exotics.
Hi, yeah. Thank you, Andreja. Let's now take a look at a couple of simple exotic structures in derivatives, which can be very helpful for certain kind of investors to take position based on what they feel like or where they stand. The first one being a digital option. So say you are a trader and you have done all your calculations. You feel that Bitcoin should reach $80,000 in the next month. So there can be a couple of ways you can take a position based on this information and to make a payoff out of it. You can buy spot or futures, but that would need a higher capital. You would have to buy Bitcoin, which is say $62,000 or $64,000 today. You can go for buy a vanilla call option, but for a call option, the payoff would start after Bitcoin has breached $80,000. So you would start making money after $80,000. Say Bitcoin reaches 85, you make 5K. Bitcoin reaches 90, you make 10K. But what if you want to make 10K or 20K just when Bitcoin touches 80K, which is your calculation? So digital option comes into play here. Digital option is a 0-1 bet on the spot, breaching the strike or the barrier. The strike is decided by the buyer who enters into this option. You decide 80K is the strike, you want 10K as your payoff, or maybe 20K as your payoff, and you enter into this option. That is what you get exactly when Bitcoin touches $80K in spot price, on or before maturity. The premium, however, would be decided based on what is the payoff that you request. A higher payoff would end up making the premium higher as well. But this is a very interesting structure based on calculations or for traders who have this sort of an view for the market. The only loss that would happen is the premium that you pay at the beginning. For a correct prediction, you make 10K. For a wrong prediction, obviously the premium goes. Next, we discuss accumulators and decumulators. So these are two very interesting structures for purchasing or selling an underlying over a spread certain number of upcoming days or weeks. Say you are an investor who has been willing or who has been wishing to buy Bitcoin. We saw Bitcoin rising from 30, 40K to 60, 70, 75K is the highest that it touched. Timing the market is not always easy. You would not be able to get the best price. So at 75K or even today at 64K, when you see the market came back, it pulled back by 20%. An investor might still be confused. Should I buy now? Should I wait? Will the market touch 55K? Will the market touch 50K? Or what happens if the market rises again and I miss this opportunity as well? So here is what an accumulator comes into play. What an accumulator allows an investor to do is buy or spread the purchase of Bitcoin over a couple of upcoming days or weeks and select a strike price which is lower than today's spot price, and that is the price at which you would be buying Bitcoin. There are a couple of parameters here. If you enter into such a contract, the initial spot price, say it is 62.5K. This is from 2 days back, but then you decide that you want to buy Bitcoin at 50K strike. So, and the number of days you would be buying Bitcoins is the next 7 days. So you buy Bitcoin at 50K. There is a knockout barrier, which is also optional. There would be a knockout barrier, which is higher than the current strike, which may be 65 or 70K. Based on the strike, this would be decided. Now, for each day, when Bitcoin spot price is between $50,000, that is a strike you as a buyer decided, and the knockout barrier, which was decided based on the strike. Whenever the spot price remains between these two levels, you end up buying one Bitcoin and you are required to pay $50,000 for that. For any day when Bitcoin price breaches the knockout barrier, which is 65K in this case, you would not be allowed to buy Bitcoin. And for any day the price of Bitcoin falls below the strike, $50,000, there would be a downside with you buying two Bitcoins at $50,000. But if we look at this from the perspective that you were planning to buy 6 Bitcoins today, the price being $64,000, you end up paying three and a half thousand dollars. So, but then if you spread this purchase over these upcoming number of days, whatever the price you pay, you would be paying only 50,000. The only catch is you may or may not be buying Bitcoin on those particular days based on the spot. But in any case, the price that you pay is less than today's spot price if you would have decided to purchase the entire set today. So for a long investor who has a very long-term bullish view on Bitcoin, this comes in very handy. The opposite of an accumulator would be an decumulator contract. This gives you the opposite benefit. It lets you sell Bitcoin at a price which is higher than today's spot. So if you want to sell Bitcoin at 70K or 80K, spot today being 64K, but you can do this using a decumulator. Again, you will have to spread your sale over a couple of days, upcoming days, or a couple of weeks. What you'll be doing is, say, next 7 days, I'll sell Bitcoin one each at $80,000. Again, those strike and knockout conditions would come into picture. Who is this helpful for? Say a Bitcoin miner. You see a steady flow of Bitcoin coming to you, and you want to already sell that at a price higher than today's spot. You can use a decumulator. Or you already you already have a lot of Bitcoin with you and you have lent it, you are earning interest. And the interest is something that you want to convert into USD and not keep in Bitcoin. So you can get into a decumulator contract for that. So yes, these two structures come in very handy for people who are willing to spread their purchase or sale over a couple of days and get a better price from the market today. I think with this, we come to the end of our presentation. Thank you very much, and I hand it back to Andrea to take it further. Thank you.
Thank you, Amrit. So thank you very much for attending our webinar today. Thanks also to the marketing team of AMINA Bank for all their support. And we open up now for any questions that you might have. You can use the chat and post your questions there, and we'll pick them up from there. Okay, seems no questions. So we'll wait for another minute or so. But okay, so we've had some questions about the services at AMINA Bank. This webinar is really intended to talk about the market and what is out there, and not specifically focus on our own offering. So if you want to know more about our own offering, then please reach out to your RM directly, and also we'll be happy to jump on a call with you and talk to you about what we are offering. So this question is, let's say the market standard in crypto options is something like every Friday. It's mainly Bitcoin and Ethereum options that trade, and it usually with most of the providers or let's say exchanges that are out there, the expiries are now every Friday of the month. With OTC providers, with the providers of OTC services like banks and other regulated dealers, or unregulated for that matter, usually you can trade any date and any strike. Sometimes if it's new trades, then the strikes are limited to 5 delta or 10 delta, which that offers plenty of opportunity really for anyone. But again, we're not so much talking about our own offering here, but yeah, that's generally the structure of the market. Okay. Okay. So I just realized that not everyone sees the question. So the question here was what flexibility do we offer with the tenors and strikes? And yeah, so please out to your RM, and we'll be happy to give you that information particularly. All right. So the question is, why are accumulators referred to as "I kill you later"? Okay. I'm not aware. I'm not aware of
Okay.
this name.
So
Amrit, if you know a bit more about this, you can answer. But I don't know about it.
so that's a fun way to put forward the downside. So when you talk about strikes in accumulators, there's a downside that whenever the price is less than the strike, you end up buying more Bitcoin then you would be allowed to buy when the price is greater than the strike. So if you are a speculator and you end up taking an accumulator with a very long tenure, say a 3-month accumulator, you would be buying 1 Bitcoin every day over 3 months. And the price keeps on falling. You see a bearish market after 1 month. You never know. So you might end up buying 2 Bitcoins every time at a higher price because you have entered into the contract for a long term. But then these structures are specific for certain kinds of investors. If you enter into an accumulator with the assumption that you would be buying that many number of Bitcoins today compared to you are spreading the purchase over the next week or month, you end up getting a better price what you would have gotten today. But then if you're a speculator and you just see that let's buy Bitcoin at a lower price for the next 3 months, you might end up in a weird space. And that's why I think this phrase comes from.
Yeah, thanks, Amrit. So yeah, you might, if you were buying an accumulator because you just wanted to make some money very quickly, you might get suicidal basically. But if you are kind of wise with your capital and just looking for an opportunity to buy Bitcoins cheaper and hold them, then I don't think that this suicidal tendency applies. Yeah, but thank you for the question.
So for everyone who does not see the question, this was why are accumulators referred to as I kill you later?
All right. So looks like there is no more questions. I'm giving it a few more seconds if there's anything left to ask. Okay. So really, thank you very much for attending our webinar today, the first one. And again, thanks to everyone that participated.